I'm Henrik Cronqvist, and I'm the Dean of the Argus School of Business and Economics at Chapman University in Southern California. And today I'm very excited to be able to talk to John Nofsinger, Dr. Nofsinger, who is the Dean at the Business School at the University of Alaska, and who also holds the William H. Seward Chair in International Finance. And Dr. Nofsinger is also an MBA graduate from our school here at Chapman. So it's really exciting to be able to talk to you today, John. You're an expert in the area of behavioral finance, and you've written a book called The Psychology of Investing that is best-selling. So tell us a little bit about what is behavioral finance and why did you get into this topic? Why are you interested in it?
Thank you very much for having me, by the way. So I first got interested in behavioral finance back when I was doing my dissertation, and that was back in the mid-1990s. And back in those days, the king theory for finance was the efficient markets hypothesis, which essentially revolved around stock prices were generally correct. They might randomly be overvalued or undervalued, but you can't find things systematically if they're random. And the reason was because the participants in the market are intelligent, rational decision makers, and together that we create these rational prices. To me, those thoughts didn't always ring true. It didn't explain fully normal people's behavior. You know, when it comes to love and money, people are often irrational. I don't like saying, you know, we make irrational decisions. We do sometimes make suboptimal decisions. And that's what behavioral finance is really all about. Identifying why we don't always make optimal decisions. What are the psychological biases? What are the cognitive errors that we suffer from? And when do we suffer from them? And I actually kind of think of it as two different categories. One is focusing on the individual. So what are my biases? And how can we reframe decisions to help me make better decisions? And the other category is a little bit more social. How, if we all have biases and we all have them together at the same time, right? They're all correlated, as we say, then we can affect markets. Then we can cause bubbles. We can cause crashes and things like that. So I view behavioral finance as focusing on the individual, and then what are the ramifications maybe in our community, in our society because of that.
Interesting. Now, so John, you wrote this book, The Psychology of Investing. And so what prompted you to write the book, and what would you like the readers to take away from your book?
When I was done with my dissertation, then I started really collecting all of this, all of these studies by all of these wonderful scholars, and putting them all into one place. And that's when I decided to write the book. And at the time, it was sort of, you know, the first of its kind, translating all of this technical research for myself, my colleagues, my students, et cetera, et cetera. And so that's kind of how the book was created. And so what is the book about? Well, it's about our biases. And there are, you know, some of the takeaways you might have. There are some very pervasive biases that occur in context after context. One of them I would mention is the representativeness bias. And our brains take two things, and if they have some shared similar qualities, the brain says, they must be equivalent or they must be alike. For example, as an investor, people will mistake a good company for a good investment. Right? A good company is a company you want to work for. Maybe they have fantastic products. Maybe they're good for the environment. Whatever you define a good company, it seems like that means it should be a good investment, but it's not always a good investment, right? Companies might be overvalued, or they may not be optimizing their profit because they're doing all these good things. So, but that's what the representativeness bias does. One aspect of the representativeness bias is extrapolation. That is, what happened in the past seems like that's what should happen in the future. So we take the past and we make decisions on that's what's always going to happen in the future. Investors chase the hot mutual funds, right? Investors buy the stocks that have already been going up in price. So they've already missed the move, but that's the ones that they pour into. And so this has a lot of ramifications on not only investors that are actively trading, but even non-investors who don't do much but have to make super important decisions in their life. For example, you're a new employee at a company, you have to determine your asset allocation for your 401k plan. So these biases are very important, and they cause us to potentially make very serious suboptimal decisions. Another example that's very common, we see it in a lot of places, is familiarity bias. This one suggests that the things that we're familiar with, we think are better. Now, I use the word better here, and I think it's a word we all think of in investing, but I don't think it has a place in investing at all. It's a dangerous word, and here's why. In finance theory, there's no better or worse. There's just risk and return. A company, when I think of better, I think of high return and low risk. But that doesn't go together in the financial markets. It's high risk with high return or low risk with low return, right? So the term better is dangerous, but that's how we think about it. And so when we think about familiarity and better, we think that our local utility stock is a better investment than the utility stock anywhere else. We think the companies from our home country are better than the companies from other countries, right? And then again, going back to your 401k plan, we find that investors tend to hold way too much of the company stock.
How can we de-bias ourselves? Is there a way for a person to de-bias yourself with respect to investments?
Really, the first step is to recognize and understand the biases, right? So kind of learn about them. If you can see the bias occurring in other people's decisions, then you know that you know those biases very well, right? So know the biases. The second step really is to, in my mind, have a financial plan or financial goal that you can always go back to and stick to. Most people don't have one. I liken it to their financial plan is they get in their car and they start driving. They don't have a map of where they're going. And in fact, they don't even have a destination. And so, they turn right if the light is red, they go straight if it's green or whatever. So they're being influenced by all the traffic and everything around them. That's just like how they invest. They're always being influenced by all the emotions and the things that are going around them. And they don't really have a good plan to stick to help guide them, right? And so I'd say, again, boring, but very important. A lot of the trouble people get into is when they hear about something great, or they hear about things and they just go buy it, and they don't actually say, hey, well, is this company make money, or does they pay a dividend, or whatever your criteria would be. I think having that criteria keeps you out of trouble. You might miss a couple of opportunities, but I think it's well worth it in keeping you away from a lot of trouble as well. Diversify, diversify, diversify. The three most important words in finance, in my opinion. Another thing is to try to control your environment. I'm a finance professor. I check in the stock market all the time, but really that's not a good way to control your environment, because it lets the emotions seep in, right? And so, and that causes your biases to continue and things like that. So, it's better to, don't look at the markets all the time. Don't look at your stocks all the time. I'd even suggest that you really shouldn't be in a hurry to make those trades, because when you're in a hurry, that's because it's your biases that are talking. So make some rules for yourself. I only buy or sell stocks on Wednesdays, or something, the 15th of the month or whatever. And that helps reduce the biases and the emotions that you feel.
About 25 years ago, we went through the dot-com period, and there was a lot of research and understanding of how the dot-com investors, they behaved and what were some of their mistakes. Now we have 25 years later on, we have meme stocks, we have new platforms, we have Robinhood, we have, the financial landscape looks different. Are the type of mistakes that retail investors they make, are they the same? Are they different across these two time periods? Is it just because the new generation is new to investing and they make their own mistakes, or did we learn anything from the dot-com era?
I would say that we make a lot of these two groups are making a lot of the same mistakes, but they're not necessarily making them for the same reason, right? They kind of get there in a different way. The dot-commers, I think, they were just buying any company that said it was going to do business online. That was good enough, right? They didn't worry about the valuations. They didn't worry about, how much business that would create or anything. It was just, that was the criteria, and they all jumped in, which is very naive. They didn't diversify, again, with the extrapolation bias. They buy the ones with the prices that went up. They got on late, and so when eventually those went down, they lost most all their money. But the more, I would say, the more recent meme investors in Robinhood and such, they're a little different. They communicate a lot more. There's a lot more data for them to analyze. But they're still ending up making a lot of the same mistakes, but for different reasons. The dot-com mantra seemed to be, we can do this without financial advisors. We can do this ourselves. We can get it rich. The meme investors are a little different. They're not so much we can do it ourselves. It's we can do it and destroy the institutional investors at the same time, right? So they went out and they found stocks that had a lot of short interest. That is, institutional investors had sold short. What that means is institutional investors will sell shares of a stock like GameStop, right, that they didn't even own. How do you do that? You borrow the shares and then you sell them in the open market. You do that when you think the price is going to fall. You make money when prices fall. You lose money when prices rise. And so the meme investors said, let's all buy GameStop. It will force the price up, and these institutional investors will lose money. They'll have to close out their short positions. How do you do that? You got to buy those shares back. You borrowed them and sold them. You got to buy them back. That buying will cause prices to go up even more, and that'll hurt additional institutional investors, and it'll snowball, which is something we call a short squeeze. And so they're buying very few stocks. They're not diversified, but most of them get into this process late when the prices are already high. And then when everything finally gets resolved and prices plummet, again, they weren't diversified. They lost a lot of money. But it was kind of a different mantra in my mind. It was, not only do we not need the institutional investors, that we can beat you at your own game.
What is the next big extension of behavioral finance?
I think the question that we don't know very well, we're really getting to know these biases, but what we don't know is, why do I suffer from a bias and you don't? Right? Or maybe at different magnitudes of suffering, right? And so we don't know as much about what is the source of these biases. Why are we making them, and why are other people not making them? So is it the experiences that we've had? Is it our genetic makeup, right? This is a classic nature versus nurture discussion. There's 3 different types of intelligence, and how do those affect our biases and our decisions? With the baby boomers aging, we're seeing a lot of cognitive aging. How is that affecting them and our markets? But the book, the biology goes on to talk about emotions and pollutions, lack of sleep. Does coffee help? Testosterone levels, personality. So there's a lot of things that can combine to help us understand why we're making that cognitive error or that psychological bias.
Been great talking to you today, Dean John Nofsinger at University of Alaska in Anchorage. Thank you so much for spending some time with us today to talk about behavioral finance and talking about the psychology of investing and the biology of investing as well. Thank you so much. We really appreciate it.
It's been fun. Thank you very much.